Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to CEO Steve McQuillan and CFO Stephen King of Avingtrans, a specialist engineer supplying niche products and services to the nuclear, defence, industrial, and medical sectors. So, welcome, gents.
Hi, Paul. Nice to see you again.
Hi, Paul.
Yeah, well, it's great to have you back on the show. Big congrats, too, on this morning's record first half results and inline FY25 guidance. But before we sort of dig through the details there, Steve, I don't suppose you could just quickly remind the audience exactly what the company does and its sort of key secular growth drivers.
Yeah, so Avingtrans, as you know, is an engineering business. And as you mentioned, we like regulated sectors like nuclear, like defence, like aerospace, medical, etc. And we have a relatively unique strategy these days called PI, Pinpoint Invest Exit. We look for businesses in those sectors who are underperforming typically. And once we've pinpointed them, we acquire them, we then invest in them. We invest in people, processes, products. And eventually that gets us to a point where we've improved the performance enough that we can go for an exit. That can take a number of years. It can happen relatively quickly. In the case of Peter Brotherhood, it was 3.5 years, or it can take 10 years, like it did for our aerospace pipes business, Sigma. We like those kinds of markets because the customers are very sticky. And instead of viewing an underperforming business as a problem, they want somebody to come and fix it. And that's why they really usually welcome us turning up to say, we're going to fix this business for you, because they want that supply chain to be stronger and more durable. And in those markets, we've got some really good growth drivers behind us. So the top one is energy. So Hayward Tyler, for example, are a business that makes pumps and motors. A lot of what drives that is pumps into power stations, including nuclear and including new nuclear power stations, and pumps on oil and gas platforms, that sort of thing. And of course, that's been driven in turn by things like data centers around the world, particularly seeing good growth in China now with HT, because they're building more power stations to power more data centers and to power AI, etc. And we're seeing that elsewhere in the world as well.
What just on that one, Steve, because I hadn't really appreciated the data center sort of driver. What exactly the products and services do you supply into there? Is it sort of pumps or cooling systems or power systems?
For HT, it's indirect. It's pumps into power stations, which power data centers. But for Ormandy, which makes HVAC equipment, it's cooling systems and tanks for cooling water for data centers. And for Metalcraft, it's pressure vessels going into data center setups. And for Booth, which makes security and blast doors, it's the security doors that go around data centers. So there's a number of touch points for data centers around the group, but different things for different businesses.
I'm guessing that you're seeing a lot of growth there in, the States in particular, I would have thought, because, I mean, they're building data centers left, right, and center on that East Coast around Virginia way.
Yeah, that's not helping all of our businesses yet, because, of course, Booth, for example, isn't really present in the States, so that could be. So that's a thing for us to think about. But certainly that's helpful to HT, as you say, and we expect to see more business in that regard going forward, particularly around nuclear. There's a lot of work going on in new nuclear as well. Of course, we're already in contract with TerraPower in the States, which is Bill Gates's outfit that he's invested $1 billion in for next generation nuclear. And we're talking to most of the other main players in new nuclear as well, GE Hitachi, Holtec, Last Energy, all those kind of guys we're talking to as well as working with some of the folks who are working on fusion concepts, although that's obviously further out. So that whole energy thing is a big driver for us and a driver of the growth of the business. A second one is around defence. Of course, defence is back in vogue now, and that's mainly a UK thing for us at the moment, but it's also starting to emerge in the US as we get involved in some of the programs there. And so we see that as a good driver for us in the future years as the world starts to pay a bit more attention to needing to spend money on defence. And I should stress that we don't make anything that goes bang. It's all about propulsion systems for us and that sort of thing. And then we've also got critical national infrastructure. We already talked about data centres, which the government obviously classify as critical national infrastructure. But we've also got Booth doing work with HS2 on the new high-speed train line. And Booth is also doing other stuff on other critical national infrastructure projects. So it's a broad range of stuff in critical national infrastructure. And then, of course, we've got Metalcraft making the boxes for Sellafield to store nuclear waste. And there's a lot more business to come down that track, as we've talked about before.
Yeah. And if you add all that together, sort of what's the sort of like position of your order book, the sort of health of your order book and your pipeline? Because I'm guessing then you've got quite a few big demand drivers there on your businesses, on your subsidiaries.
Yeah, sure. Let's let Steve take that one.
Okay, right, fine. Well, we'll move over to Stephen then. If you could take us through the numbers and the order book.
Yeah. Okay. Sure. Yeah. Well, good, strong half one. Over 50% of the city expectations on revenue. So normally we're a 45-55 split. So we're slightly ahead of the curve there. Order book, as Steve says, very strong. In particular in AES, medical's very small in comparison. So AES is going to be 95% on FY25 and 60% for FY26. And don't forget that we've got a couple, as Steve just touched on there a little bit, a couple of very long-term contracts, one for Sellafield and one for HS2. Sellafield's over 60 million in the order book, and Sellafield's over, well, we just won a current order for about 4 million. So I think it just topped itself up to over 42 million, something along those lines. So over 100 million for a small company like ourselves is a really strong order book, long-term order book. And I guess then when you look at all the statistics on the first half, Paul, I mean, revenue up 13.8 million, 21% to just under 79 million. Bit of difference between OE and AM. OE has come back a lot stronger. Maybe that was a bit of a dip a few years ago with confidence in manufacturing, but that's come back plus 11 million to over 50 million, and 26% growth half on half. And aftermarket, okay, it's about a third of that size, so it's increased 2.7 million and about 11.5% growth in the period, half on half. So despite it only growing 11%, both have grown really strongly. The only thing there is that the OE percentage has come down to about a third, 32%, which has a slight impact on gross profit margin, but we still added 3 million, only 3 million to the gross profit line. So I think that's relatively strong. Yeah. And then when you get down a little bit further, EBITDA growth to 8.7 million, 11% half on half. Again, we've got two, as people probably know reasonably well, we've got the very mature AES sector and then the medical business, which is obviously developing for the future. But if you look at AES, it was up on the half to 11 million, so up 2.5 million, something along those lines, and that's nearly 30% growth on EBITDA. So it's a really strong first half, as I said. Medical, we forecast that medical was going to cost us a bit of money this year as we develop the products. So still under control. It's EBITDA was a loss of about 1.7, mainly on the Adaptix side, as we drive to commercialization, and probably more of that later.
Yeah. I saw your margins in your EBITDA for your advanced engineering services actually increased. It went from 13.3% to 14.3%, even though your gross margin. So you've got pretty good economies of scale coming through there.
Yeah.
Yeah, I mean, it's always the same, Paul. Once you get over a certain level, then you can drop it down to the line, but it depends on what contracts you've got, doesn't it? Sometimes you get a really good aftermarket contract, and other times you're doing little bit more which is slightly lower margin. The key thing for us is growing, not just gross profit, but growing EBITDA and generating the cash to help fund the medical division. I mean, just turning on cash. I mean, cash went out to debt went out, should I say, to 8.9 million. So pretty much in control. Gearing less than 8%, 7.7, and that's helped fund some of the medical projects in the period. So we spent about 4.5 million on the two medical projects that we've got, but that was what we forecast to the city, and it's a year of investment for the future for Avingtrans shareholders.
Yeah. Good. Okay. I want to turn to the medical division there, Steve, and take us through your latest thoughts on Adaptix and Magnetica.
Yeah, I mean, just to remind everybody what they're doing. So Adaptix is working on novel X-ray systems, 3D tomosynthesis, it's called. So you get 3D
well
X-rays.
Pronounced.
I know, instead of a 2D X-ray, you get a 3D X-ray. like a stack, like a CT scan almost. It's like we joke that it's kind of poor man's CT. It's almost what it's up to in terms of capability. And Magnetica is working on a small format MRI system for orthopedic purposes. And that's why we invest in both of them. They're actually on a parallel path. So the markets of interest at the moment, there are three for Adaptix. There's orthopedics, there's veterinary, and there's non-destructive testing, NDT. And Magnetica is just working on its first product at the moment, is orthopedics, and we'll get to some of these other markets later, but it has to concentrate on orthopedics at the moment. So Adaptix is doing well. They're now in commercialization phase, which is why it looks like we're making bigger losses there, because you can't capitalize any of the development anymore, or less of the development at least. And so they have started selling the veterinary product in the UK and the US, appointed distributors there. We've also started selling the NDT products in the UK and the US, appointed distributors there as well. And then we'll be appointing more distributors in the US and Europe for both of those markets and for orthopedics during the course of this year. And then that's really the game for us now with Adaptix, is get the distributors appointed, get them trained, get them up to speed, and then get them selling the products. And that's what will drive the growth curve for Adaptix now. The products are well accepted by the market, very good reactions. The quality of the images is a kind of real wow factor for a lot of the customers. They're impressed by both the quality and the speed of the image acquisition. And so that's what's driving the interest in the products. And so it's really a question of just, running out, which is no mean feat, by the way, appointing up distributors and getting them up to speed, etc. But that's the stage that Adaptix is at now. And so they should continue to grow going forward now with all those products.
And with just on Adaptix, how many units would you anticipate to sell over the next sort of like 18 months or so?
Oh, it'll be hopefully between 100, 200 units, something like that, Paul. Not more than that in the next year, I don't think.
Yeah.
But it'll keep building from there, really. So it's a question of how fast the distributors themselves can build sales and build market space. I know eventually we hope we'll be selling thousands of units, but that's probably some years off before we get to those kinds of numbers. But yeah, over the next year, 18 months, probably 100 to 200 units, a mix of mainly orthopedic and veterinary. The NDT sales in unit terms will be much smaller. They're bigger systems and the sales cycle's longer. That's going into markets like aerospace, where I think you probably know it's the product won a Innovation of the Year award from the Aerospace Technology Institute. So it's certainly recognised in the market as quite an interesting development. But we know from our previous experience, the sales cycle in places like aerospace is pretty long. So we haven't forecast to have very big numbers of NDT sales over the next year to 18 months.
Yeah. And then with Magnetica, what's the sort of timeline for submitting the FDA application to get approval?
Yeah, so this has been the big frustration for us over the last number of months, year or so, is just the sheer volume of work we've got to do for the FDA with Magnetica. It's a much bigger volume of work than for Adaptix, for the simple reason that it's a bigger, more complex system. The Magnetica MRI system has 32 subsystems. The Adaptix system has 8. And many more of the Magnetica systems are homegrown rather than commercial off the shelf, so they don't have any FDA prior history. So that means we've just got to do a huge amount of extra work to get to the right point with the Magnetica system. The FDA also threw a rock in the pond last year by upping the ante on cybersecurity dramatically, and that's caused a load of extra work for us as well. So we're just manfully working through all that at the moment. The team's working very hard on it, literally thousands of documents to be prepared for the FDA for this system, and we now expect that we'll submit that application to the FDA. It'll be in the second half of this calendar year now, we think, and hopefully we'll get the approval during this calendar year, therefore, and then we're off to the races. The product works. We've got images of it. The prospective customers are really impressed by the quality of the images. So it's now just a paper chase for Magnetica. And as I say, don't want to belittle that because it's a huge amount of work, but the product works. We're not now saying to ourselves, does this product work? We just have to go through all the paperwork that's necessary there. And it is a mountain of paperwork, but that's how it is. Everybody's got the same problem there. We don't think we're going to be affected by the DOGE thing in America, where they've now taken out people from the FDA. We'll see. That might be an issue for us, but we're working with a third party who's appointed by the FDA to do the work on their behalf to approve products, and then they just submit it to the FDA to say, right, we've checked this and it's okay, can you just rubber stamp it? So that should mean that we're bypassing most of the hassle that could be there with the FDA, but we'll see. I mean, who the hell knows what's happening in that regard with Trump? And I mean, in that respect as well, we also think we're better placed than most on tariffs because of the way we're structured. Because in the US, we have a US supply chain making US product for US customers. In the UK, we have a UK and European supply chain making UK products for UK and European customers. And in China, we have a China supply chain making products in China for Chinese customers mainly. So the three groupings are kind of self-contained, and we moved even more that way during COVID because we wanted to make sure we weren't caught out by too much by shipping stuff around the world. So we upped the ante on that during COVID. So we're quite well shielded from tariffs, but clearly the whole situation is so unpredictable. You can't say we're not going to be affected by it. There'll probably be some unexpected effects that we don't know about.
Yeah, well, you might find some of your rivals, if they import into those particular markets, then it's sort of like it pushes their prices up. So, yeah, we'll wait and see.
Yeah, and I mean, obviously in medical, where we're making the products in the UK and Australia, we're wary of that as well, but we've already got plans in hand to make more of it in America, should that need arise. Adaptix were kind of going down that path anyway, because as they get into high volume and America's the biggest market, then they'll want to do assembly test in America anyway. So that was already in hand. And Magnetica, as I say, we're going through the work at the moment to say how much of it could we make in America if and as and when necessary.
Yeah. Okay. Well, we'll just pivot to another section, bit of sort of corporate developments, M&A. I'm not sure who's the best person to talk about this, but when we chatted about 3 or 4 months ago, you mentioned over the next 12 to 18 months there might be some exits and disposals, and also some potential opportunities with innovative funding vehicles for the medical. I don't suppose who's the best place to update.
Well, I'll have a go first, and Steve can pitch in as well, actually. So,
Steve, why don't you cover the medical side, and I'll cover the AES side.
All right, yeah. So, fair enough. Okay, let me do medical then first, and then you cover AES. I think from a medical point of view, as you say, Paul, the game there is that we'll probably go into IPO. We're not against the trade sale for either of the medical businesses, but it's more likely we'll go to IPO. And whether that's an AIM IPO or whether it's an ASDAQ IPO, we're keeping those plates spinning at the moment. We're not going to make that choice yet. And what we're also doing, obviously, is therefore doing the work to get those two businesses to the point where they're capable of being IPO'd. At the moment, you would have to say it's too early. We wouldn't get the proper valuation for them, I don't think. But, as I say, with Adaptix now in commercialization phase, you could see that we'd be ready to go for IPO in Adaptix probably more than a year out, but less than 2 probably now for Adaptix. Is probably in that range, with Magnetica being 6 to 12 months behind that. And of course, the other thing we might do is join the two businesses together. There are pros and cons to that as well, actually. So literally at the moment, we're keeping as many plates spinning as we can and allowing ourselves to have the maximum options on IPOs and exits. But we think that, the market should be improving for IPOs and exits in the US in particular, at least over the next 12 months. So that should help us to get to the right place with these businesses. And hopefully, we all hope AIM and the London market's going to be looking better in that sort of time frame as well.
Yeah, good.
Steve?
Okay, Steve.
Yeah, so obviously AES is a much more mature business, and we've done this many times. Pinpoint, invest, exit. The markets haven't been great in the past few years for exits, I would say. Typical difficulties, PE not understanding or not knowing what our chancellor was going to do with carrying interest and bits and pieces, similar in the US, and various tariffs now. So there's a lot of things, not barriers, but it probably needs to settle down a little bit. Saying that, we've got a very mature, as we just discussed, we've got a very mature, probably portfolio now. And as you said, Paul, we said we'd probably be looking to try to dispose something in the next 12 to 18 months. What's the most likely? Well, it's probably the most mature business. Ormandy is a very mature business. We've turned that around. We've made a small investment, which has really topped that up very nicely, and it's got some interesting markets in infrastructure that hopefully should be coming back if the government can spend the money, mainly UK based. Of course, the big part of our group is HT, and of course Flowtech, Flowserve, and all those bits and pieces are very current at the present moment in time. But if you actually look at a lot of the big players there, they are PE owned. And obviously that has that thing on carrying interest. So we wait and see on that, but it is maturing very well. The ones that we've got gates, I guess, are Steve mentioned earlier, maybe Booth, where we still feel that we can increase that level, maybe even double that in the next few years. The aftermarket, whilst it's over 10% now in Booth, we can probably again maybe double that in the next few years. We've got overseas opportunities, so there's probably willingness to keep that for a little bit longer than the 3 to 5 years. And then of course the other big gate is over at Metalcraft, where we do the 3-meter cube boxes, and we still wait for the 900 million. It must be 1 billion by now with inflation.
Yeah, we should say 1 billion. It must have got inflation to 1 billion by now.
So you know, we wait for that one, but everything has its price. Yeah. So yes, we would be happy to do some exits. Equally, if a right nugget comes along, then we would look at it to add it to our portfolio. So you know, it's a case of just hanging tough, I think, on with some of those ones at the present moment in time, and moving them over the next 12 to 18 months while looking for the next nugget.
Yeah, well, that's something to look forward to. I would just highlight to investors, house broker Singers have some of the parts valuation just on the advanced engineering services division of 525p. And then if you add in a separate valuation for the medical division, which is somewhere between 250 and 420 pence per share for that particular division, you get roughly around about sort of like high 700s to 900p per share, compared to a share price of £3.50 currently. So
the upside there, you would hope.
There seems some gap, no doubt about it. Okay, brilliant. Well, if I don't know, Steve, any sort of closing remarks for investors for the next 6 months? Optimism and obviously, you know, continuing the business.
Yeah, I mean, and it's interesting how different investors see us, Paul. You know, we've had people say they really like the pie thing, get on with it. Why don't you do your next exit? We also had people say don't exit anything because we like it, we like the shape you're in, and we enjoy the fact that you're growing, etc. So it's difficult to please everybody, but obviously what we plan is clearly more of the same organically over the next 6-12 months. Certainly, we plan to see the medical businesses get through their commercialization phase. Magnetica obviously a bit behind, but still we'll get into that commercialization phase in that sort of time period. And that clearly makes a big difference to us because we're still spending quite a lot on those. But as they get into commercialization, they don't have to go too far down the track before they start to make money. So that's going to be the big switch. Not this financial year, maybe not even, well, towards the end of the next financial year probably, and certainly into FY27, that's when we'll really see them making a big difference. So that's what I'm sure everybody's waiting to be proven, is that we can make money out of those two businesses, and then we're really off to the races because AES itself is doing really well, and will continue to do so, we believe, because of the growth factors that we've talked about. And medical, once it can stand on its own 2 feet, then is going to make a big difference to the group as well.
Yeah, brilliant. Okay, fantastic. Well, very much looking forward in touching base again for the full year results. I think it's at the end of May, isn't it? Is the year end? I think, is that right?
Yeah,
correct.
Yeah.
Yes.
Great. All right. Well, thanks a lot then, guys, and speak to you sometime in the summer.
Thanks, Paul.
Thanks, Paul.